On Monday, Nvidia's own bondholders panicked. The cost of insuring its debt jumped to the highest level on record, the largest single-day move it has ever had, and the stock fell about 2.5%. On Tuesday, all of it reversed. No contract was signed, no product shipped, no earnings came out. Jensen Huang simply put one number in writing, a hard limit on how much risk Nvidia would carry, and the credit market took the deal on the spot. That number is the whole story of the week. I'll get to it. First, the announcement that stole all the oxygen while this was happening. Here's what OpenAI actually shipped. It split its vetted security program, Daybreak, into two tiers. Blue is for defenders, malware analysis, incident response, secure code review, patch validation, the general frontier models with the guardrails adjusted for legitimate security work. Red is the sharp end. A purpose-built model called GPT 5.6 Cyber, for vulnerability research, exploit validation and offensive testing. Getting in takes identity verification, active monitoring and legal declarations, and starting September 1st, a physical hardware security key on every single Daybreak account. The number everyone fixated on is a refusal rate that basically collapsed. OpenAI built an internal benchmark of requests involving exploit chains, authentication bypass and privilege escalation. The stuff a normal chatbot slams the door on. Standard GPT 5.6 with its usual safeguards completes 1.5% of them. The Daybreak Blue variant, 2%. GPT 5.6, Cyber completes 95%. The previous Cyber model managed 57.3%. So this isn't really a smarter model. It's a model deliberately trained to stop saying no, and it found real things. OpenAI says its researchers used it to surface two undocumented flaws in V8, the JavaScript engine inside Chrome, which could be chained together to corrupt memory and break out of the browser's sandbox. It also helped identify at least 5 vulnerabilities in a major mobile operating system, 3 critical database bugs, and more than 400 privilege escalation issues in a widely used OS kernel. Under OpenAI's own preparedness framework, it's rated high for cyber capability, not critical. High. That is a genuinely important story. In market terms, it's also weightless. Nothing in it changes $1 of capital expenditure, a gigawatt of planned capacity, or a single delivery schedule. And that's the frame worth holding on to. This boom has a demand side and a supply side, and they are not equally constrained. Labs like OpenAI are demand. Nvidia is supply. Supply has been the binding constraint this entire cycle, which means the interesting moves almost never come from the side making announcements. So the supply side's move. On Monday, the Financial Times reported Nvidia was assembling a $500 billion financing package with Wall Street's biggest firms. Nvidia confirmed it the same day. The market's first reaction was not applause. Shares fell roughly 2.5%, about $130 billion of market value gone in one session. And in the credit market, the part nobody puts on television, the cost of insuring Nvidia's debt against default jumped by the most on record. Here's the actual structure, because that headline number is doing an enormous amount of work. Nvidia signed memorandums of understanding, not binding contracts, with Apollo Global Management, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. 6 separate, independent financing platforms. The goal is to mobilize over $500 billion of third-party capital, over time, for customers buying Nvidia systems. Nobody has committed $500 billion. Nvidia is putting up no cash. And the whole thing is still subject to definitive agreements. Jensen Huang's pitch fits in one sentence. In AI, compute is revenue. An Nvidia GPU isn't equipment quietly rotting in a rack. It's a cash-generating asset, fungible across customers and operators, transferable, kept current by CUDA. Apollo's president Jim Zelter called modern compute a scarce, mission-critical asset class with compelling investment characteristics. Translation. They want to underwrite chips the way you'd underwrite an aircraft or a toll road. And this is where it gets genuinely interesting. So ask what problem this actually solves. Nvidia's customers are not short of appetite. They're short of balance sheet. A neocloud or a frontier lab can want 10,000 racks and still not fund them, because lenders look at concentration risk and stop returning calls. Every one of those stalled conversations is an Nvidia order that never gets placed. So Nvidia went and rebuilt the plumbing that turns appetite into purchase orders. That is not generosity. That is demand engineering, and it is a very different thing. Felix Huang at Hedgeye put it about as bluntly as anyone could. In effect, they made Nvidia's product cheaper without really cutting GPU prices. Sit with that. A lower cost of capital on the buyer's side does almost the same work as a discount. Except the discount comes out of the credit market's pocket rather than Nvidia's gross margin. The list price holds. The effective price falls. And Nvidia's income statement never has to show the concession at all. Morgan Stanley tried to put a price on the upside. Assume roughly 5 gigawatts of new global capacity a year, GPUs renting around $13 an hour, and Nvidia capturing about 35% of the surplus. You get up to $51 billion of new annual revenue, at gross margins the bank describes as approaching 100%, and close to a 10% lift to fiscal 2029 earnings per share. They kept an overweight rating, target $288. Those are assumptions, not results. Which brings us to the objection that actually moved money. Critics call it circular financing. Nvidia backs the buyer buys Nvidia, and reported demand starts partly measuring Nvidia's own support. It's not hypothetical. Nvidia has been in talks over a backstop worth up to $250 billion tied to OpenAI's lease arrangements, and separate discussions around $350 billion in chip purchase financing. Its existing credit exposure sits near $3.5 billion. Hold that gap in your head. Credit analysts don't care about vision. They care about who eats the loss. If the vendor finances the customer, then in a downturn Nvidia isn't just losing sales, it's holding paper on assets whose value depends on the exact demand that just evaporated. That's the fear that showed up in the swaps market on Monday. 5-year protection on Nvidia's debt spiked to a record, the largest single-day move since that contract started trading actively back in November of last year. So on Tuesday, Nvidia answered with a boundary. Huang said the company's role stays secondary. Residual value support capped at 25%, offered project by project, on selected opportunities only. Meaning, if a financing term ends and the hardware is worth less than the lender assumed, Nvidia covers part of that shortfall. A quarter, at most. Measured against the full program, that's a theoretical ceiling somewhere near $125 billion. It's a ceiling. It is not a blank check. The credit market took the deal. On Tuesday, 5-year credit default swaps on Nvidia narrowed to roughly 72 basis points, according to IC Data Services. Its 5.625% bonds maturing in 2056 tightened to 113 basis points over comparable treasuries. The stock stopped bleeding and finished the session close to flat, around $217. One clarification about exposure, and a record credit panic simply priced itself back out. Wall Street is not fully convinced, though. Nothing here is signed. These are memorandums subject to definitive agreements, and the first debt deals are expected to reach the market in months, not days. Analysts also note that a 25% residual guarantee is still real exposure if utilization slips or resale values fall. A smaller hole in the boat is still a hole. And there's one risk almost nobody was pricing on Monday. Wait until you see where that one comes from. CNBC flagged it Tuesday. The plan's biggest vulnerability is China. The logic is uncomfortably simple. This entire model assumes GPUs stay scarce, fungible and easy to resell. That's what makes compute usable as collateral. Policy can break that without anyone missing a payment. Export rules, tariffs, a supply shock in memory or advanced packaging. Any of them can move the residual value of the collateral. You can underwrite credit risk. It is much harder to underwrite a rule change in Washington or Beijing. Bloomberg made a related point the same day. There are two problems Nvidia's money cannot solve: scarcity and margin. Capital can conjure a data center's financing in an afternoon. It cannot conjure high-bandwidth memory, transformers, turbines or grid interconnects. And the memory squeeze has already been pushing up prices on consumer devices that have nothing to do with AI. Financing accelerates orders. It does not accelerate physics. Nvidia reports earnings on August 26th, and that's where the two start colliding. So here's the number I promised, 25%. That single cap on residual value support is the whole difference between Monday's record credit panic and Tuesday's calm. OpenAI took the headlines with a model that hunts 0 days in Chrome. Nvidia took something quieter. A position where 6 of the deepest pools of capital on the planet now have a reason to keep its orders flowing, while its own downside stops at a quarter. Headlines expire in a news cycle. Leverage compounds. If you think that 25% cap holds under real stress, tell me in the comments. And if this helped you read the story properly, like it, share it, and subscribe. What do you think? Drop your thoughts in the comments. If you enjoyed this, smash that like button. See you in the next video.